Global Management Chief Economist Torsten Slok joins us now. Torsten, what do you think about the market's expectations here around the Fed? That it's done, that it's going to begin cutting rates as early as May, and we're going to get a few rate cuts next year. That certainly helped the overall mood.
Absolutely, and I do think that's a reasonable outlook, that the Fed will begin to cut by the middle of next year. It's fluctuating between May and June, but the bottom line in that, Sarah, is that we should expect rates to stay at these higher levels for at least another 7-8 months. The key question, of course, is given some of the trends that we're seeing in delinquency rates for auto loans and credit cards, given some of the trends that we're seeing in default rates for high-yield loans, will these trends continue to really create more pain, if you will, both for the consumer and also for corporates? So in that sense, the lagged effects of the Fed keeping rates high are likely to still continue to weigh on the economy. That's also why the consensus still has growth slowing down quite substantially over the next 3 quarters.
Yeah, but it all hinges on the consumer, Torsten, and what we were talking about. You know, as Rick brought the consumer confidence expectations, they went up. And maybe that's because gas prices have eased. That generally, helps expectations and consumer confidence. But what do we make of where the consumer is going?
But true. Remember also, as you covered so well, Walmart also gave some somewhat worrying signs about where the consumer is at the moment. So we're seeing a little bit of a mixed messaging, if you will, in the data, including also, as I just mentioned, the risk that if we still have more people falling behind on their payments because interest rates simply are very high for a lot of households, that will continue to bite harder and harder. So from a Fed perspective, the Fed is trying to slow the economy down. And if they don't succeed with slowing consumption down because there's either still excess savings left, or, as you're saying, maybe gas prices coming down, well, that would then imply that maybe then the market should be pricing that rates are going to be higher for longer than what Fed Fund futures are pricing at the moment. In other words, maybe we need to get all the way into Q3 before the Fed will begin cutting.
Do you think that is what's happening?
Well, I think that what's really critical also here is that we are running out of excess savings. That's a very important debate, and Fed working papers are debating this. The San Francisco Fed has been writing about this, New York Fed, the Board of Governors. I do think that we will ultimately, over the next several quarters, run out of excess savings. Combining that with student loan payments starting here in October, last retail sales report for October was not great. So it is a mix of things that are hitting the consumer at the moment, and with the same combination of rates staying higher for longer, I still think that the downside pressure on consumers will continue. So I do still think that the consensus is right with the expectation that consumption should be slowing over the next several quarters, and therefore the Fed will ultimately succeed with the goal of slowing the economy down, with the ultimate goal of slowing inflation down.
When we talk about consumers, Torsten, it's not all one big brush. I'm just curious about the buying power, sort of we call the low end, which may be under more pressure versus the middle and towards the top. Is there any sort of data that kind of shows, the impact on the economy from a slowing at the lowest end perhaps is not that significant?
Well, if you look at how much money people have in their checking accounts across the income distribution, the data shows that the top 20% of incomes, they are essentially the income group that has almost all of the excess savings that we are talking about. In other words, remember, the 20% highest incomes in the U.S. account for 40% of consumer spending. So it is absolutely the case, David, as you're saying, that there is more tailwind to consumer spending for upper income households. If you combine that with delinquency rates going up, again, on auto loans, credit cards, for lower income and middle income households, you do see more of a bifurcation when it comes to consumers, that you almost have a tailwind for the upper incomes and you have a headwind for the lower incomes. And is that combination of when will the scales tip? Is there a risk here for the macro that we will begin to see overall consumer spending slow down as the Fed again is trying to achieve the goal of slowing the economy down? I do think that we should be, exactly as you're highlighting, monitoring this difference in what are different types of consumers doing at the moment.